Hello and welcome to Business Television India. I'm Piyush and you're watching Market Guru. It has been since last few shows. So again, we have been talking about how again the macros have been changing, how our market gurus again actually are thinking about the markets at present. And today, let's carry the discussion forward with the market guru today, Andrew Holland. Andrew, welcome to the show. Now, first up, what are your thoughts again? And this time I would like to ask you, we're moving towards the year end. And if I look at the rupee again, the strength continues, and the recent commentary from the US Fed again indicates it's not looking that sort of hawkish again. We're not talking about 4, 5, 3 rate hikes, perhaps maybe again less rate hikes. That could also be a possibility here. And fund allocation will again start from the FIs from the January. So how is the overall scenario from the Indian markets looking to you?
So I think, in answering that, I think I still think the next 6 months are going to be somewhat kind of more volatile. But let me just take from the Fed last night. I mean, first of all, the Fed chairman said that he was below neutral. And everyone got excited because they think he's not going to go above neutral, which might well be the case. But two of the things he said, which was interesting, was that he's concerned about the high levels of debt in corporate America, and they're sitting on something like $3 trillion worth of debt at BBB rating. So interest rates could have an impact there. And the second thing is that obviously whilst saying that he's going to keep towards neutral, he's also saying there's a bit of a slowdown, or he's worried about the fact that there's not going to be no tax reductions next year. So those would say to me that there's a little bit of worry on the Fed side over a number of things which are not to do with the economy as such, because the economy continues to do well. So that's the first point. Now this weekend we have China and President Trump hopefully getting to some deal. And thereafter we have OPEC next week, we have Brexit in the second week of December. So there's lots of things, moving parts there, which could either be a Santa Claus present, the markets love everything, or it could just leave us where we are, which is possible trade war, messy Brexit, and oil prices continuing to either fall or rise depending on what OPEC do. So that's how we kind of go into December. So there's a few things there which can either kind of have the markets move higher, but I think my best guess is that Trump will try and do something with China, because if you look at what he's done at home, it's really starting to hurt now. I mean, the fact that GM is shutting plants and losing workers can't be good news. So I'm sure he's going to try and do something with China. So I think that the risks are probably to the upside in the very short term if some of these things come through. But thereafter, I think going into 19, and I'm sure we'll talk about that, I think there's other kind of risks in the first quarter which we have to kind of take into account as well.
Right. So again, there are multiple moving parts, but from that perspective, from a sectoral sort of perspective, we have seen the second quarter results. We have seen the macros again turning around, the crude price decline, and then again a lot of raw material pricing decline is also actually being seen from the consumption point of view, from the chemicals point of view. From the sectoral point of view, what are the sectors which are now actually coming to the fore or coming under your spotlight at present?
So whilst they've been in our spotlight anyway, as you know, we've liked the kind of private banks and the corporate and retail banks. If I take what I'm thinking about going into next year, and also the fact that whilst we will see another rate hike in the US, I think the dollar's probably done most of its rise over the past few years actually. So what you could get is obviously a weaker dollar going into, or expectations of a weaker dollar. And what that would mean was that more money will come into emerging markets, and India will be a beneficiary of that. And that just adds liquidity into the market and eases some of our concerns over liquidity in the Indian market. And that means that the banking sector is probably going to be a big beneficiary of that. So I think the banking sector is one area which I think is probably going to help lead the market higher if some of those moving parts we talked about are still positive.
Right. And when we're talking about the banks and the earlier, again, as you were just highlighting, the last time we talked about the private banks, What about the other sectors, consumption? Is it something where you think, is it looking now attractive? There has been a period of consolidation, there has been a period of slightly compression valuations, but again we've started seeing some run up. What's the view there? And if there is some sort of opportunity which you're spotting there?
Yeah, I mean, FMCG is the area we've focused in on, and that can, after, as you said, that period of consolidation started to move ahead again. I mean, India is going to be all about consumption over the next, many years. So, biting the bullet even at these kind of levels is okay with us. So FMCG is very much on our kind of list of stocks which we own and continue to do that. Now looking at other areas, so the autos, I think in the short term maybe the action we saw has been done for most of them, and there will be a bit of a slowdown from the heady growth rates, and that's not a bad thing. But there's one or two stocks within the overall sector which we're liking. Because valuations are more attractive, but it's not as compelling as it was maybe a year or so ago, but compelling enough is still FMCG, so that's where we're focusing our kind of efforts.
Right, Andrew, stocks again like HUL, Dabur again, now if I recall, HUL again has already seen a 10% rally from the recent lows. Dabur again basically almost 8% rally from the recent lows. Now again, if you take a look at the Britannia, again has been doing good. Colgate again actually has seen a good, very strong rally. Now there has been a sort of M&A action also, if I talk about, again, though it has not completed, GSA Consumer. From that perspective, usually you go for a long short strategy or a sort of long strategy. From that perspective, are there actually still good opportunities from the perspective of Dabur's or HUL from the consumption pack?
Yeah, I mean, the whole sector. I mean, I'm not going to go into which company, but the whole sector is going to be a huge beneficiary of the GST, over many years. But also, I've mentioned previously to you, Piyush, is that that top line growth which was missing for many years is now back. And obviously that has a big impact on bottom line profitability for all of these companies. So that's the kind of growth you're going to start seeing from FMCG, which was absent for many years, and that's why the re-rating, to my mind, it will continue. Maybe more on a gradual basis over the next 1 year, but certainly it's also in these kind of difficult times, and we talked about all those different moving parts. It's a good place to hide as well, because growth is going to continue in terms of the domestic Indian economy, and spending in these products is not going to stop either.
Right, so that was consumption, but what about the other consumption sort of discretionary spending? Again, we can talk about durables, appliances, again we can talk about the other sort of footwear stocks, because if I look at the correction again, it has actually happened in the footwear stocks, but still the valuations are not actually totally inexpensive. If I talk about the appliances again, lately again there has been a surge for the appliance stocks. Even if I talk about durables, there some sort of sentiment is again coming back for them. The summer actually had not been that kind to them. What about that part of the market? How actually looking at the discretionary space?
Yeah, it's obviously, you have to go, you've just mentioned within different sectors there, so you have to look at each of the sector and think about whether you think that will be sustainable. Obviously in the kind of non-discretionary it is, but we've seen that some of these companies' valuations, as you've mentioned, have come to reasonable levels. I'm more comfortable on the Unilevers and Nestle's of this world than I am on discretionary, because I don't, some things can just have people put their hands in the pockets, higher interest rates more recently. So I'd rather be where I know that there's going to be solid demand at the moment. But the valuations have looked a lot more attractive, but not compelling enough for me to kind of want to kind of jump into any of these kind of subsectors.
So Andrew, are you actually trying to say that still you don't see that signs of strong demand or demand revival? Because the second quarter commentary again, a lot of two-wheelers and FMCG names again, they were talking about slightly softer rural demand. So from that perspective and from a holistic perspective, are you slightly skeptic in terms of demand strength at present, and you're trying to wait and watch at present?
No, you see on FMCG, I can take a broader brush, right? Because it's products which people will continue to buy. On discretionary, you know, if you take say autos and two-wheelers, you know, then you've got to look within each of the companies of how they're doing, what new products they're coming out with. So it's slightly different. I'm not against it. But I think you have to be a little bit more kind of circumspect in which kind of companies you want to buy, you know, in terms of not just the valuations, but, you know, can they, you know, deliver on market share and then top line sales and so forth. So, you know, it's a little bit more difficult to kind of differentiate between each of the companies than it would be, say, in FMCG, where you can clearly see that the sector as a whole is seeing, you know, very, very robust demand.
Since again we're talking about the consumption pack here, any themes which you think is not looking attractive at all, maybe is actually worth shorting, or maybe again it's worth reducing your positions, switching to underweight again, any such themes which you're spotting at present?
Well, there's no real kind of big negative theme. I mean, obviously there's you know, there's certain sectors which, you know, will continue to be under, you know, pressure of the real estate sector. You know, parts of the kind of investment, you know, capital goods will, you know, certain companies will, you know, in terms of execution are still not delivering. So there's, you know, it's more individual companies within sectors which are, you know, are still struggling along, you know, where the problem is. But, you know, obviously with the oil price where it is, OMCs are not so attractive as they were, you know, 2 months ago. Anyway, 2 months ago, the government took half of their profitability away. So you're always struggling with OMCs, whichever way, up or down. So there's those kind of sectors which, you know, really don't, you know, are kind of hostage to either outside global factors or government intervention.
Right, important point and interesting point. I wanted to ask you this question since you brought it up. Let me ask you this, not from a stock perspective, but from a sort of a broader perspective here. OMCs, are they still an area where again one actually can happily be negative? Because there are two moving parts. Number one, we still don't have clarity in terms of political certainty here. But number two, crude prices have declined. And when I look at the refining margins, it tells me the December quarter is going to be tough. Inventory losses, then again gasoline cracks actually have literally again fallen again almost towards $2 and $3 per barrel. From the OMC point of view, valuations point of view, how is it looking to you?
You know, I always struggle with the oil marketing companies, and I'll tell you why. Is that I'm always got one eye over my shoulder in terms of, you know, any kind of, as I said, government intervention, and, you know, so they're not really you know, they're hostage to something else which is not in their control, and so the oil price is definitely not in their control, and obviously the government can you know, demand things which we weren't expecting. So, you know, there'll be times when you know that the stocks will say rise, and probably a bit like the PSU banks, you kind of want to rent them, but you never really want to own them fully, because of outside factors which can hit you both sides. It's a bit like the pharma sector, actually, which I know you always like to ask me about. But, you know, even though you've had that nice rally, you know, in some of the stocks, you know, every time you feel a little bit more comfortable, something comes out to hit you, and within the sector or certain companies. So, you know, you can't be fully kind of, you know, resting at night in these stocks, because you don't know what's going to come out the next day. So, you know, in other words, you know, you could see OPEC, you know, deciding to, you know, reduce, you know, their output, which obviously have an impact on oil prices. But, you know, does that really matter for the OMCs anymore? Because the government could take some of that away. So I'm not sure what the upside potential is for OMCs because of these factors.
Right, but Andrew, this time I'm not going to ask you the pharma question, because I have more themes, and the theme I want to ask you is the fall in raw material prices. And when I look at the coal prices, there's a decline, petcoke prices, there is again a decline, fuel prices, there is a decline. And this makes me think, what about a lot of themes or stocks again, where again there could be some interesting sort of developments here. Cement is one space again, so there is going to be an impact there. Then again, logistic, perhaps smaller again from your context again, since you look at the larger stocks here. But and the third again, basically, what I want to ask you is, from this perspective again, how we should be playing on, like what are the themes we should be focusing in the context of fall in the raw material prices?
Yeah, see, I think again, just playing, unless you're saying, Piyush, that you expect, commodity prices and input prices to continue to fall, it's a kind of it's a one-off margin impact actually, which helps you, gives you a bit of a tailwind. You've really got to get the kind of top line growth, still accelerating for all of that to play through. So if I take cement, I suspect cement really doesn't have a lot of pricing power at the moment. So the beneficiary would be that the margins don't get squeezed as much as they have been doing, and that's about it. It's not as though you can say, there's a momentum behind the whole sector where pricing and is going to rise. So that's the kind of thing which you need the both of those to be running in parallel. So for example, in the FMCG, there will be certain sub-segments of that which will benefit, and they've got the growth too, which will be sustainable going forward. So that's the kind of thing we look for. So I'm not. I don't think that's the theme that I want to play. It's a bit like if you take the rupee now, it's at nearly 70, around 70. So those tailwinds which the IT sector have enjoyed are being taken away a little bit in the short term. But it doesn't mean that they don't have the growth to go with it. So that's what you've got to look for, is what else is a fundamental around it rather than just a margin improvement, because it might be that they'll have to give some of that away as well to keep their sales, or they might do more on advertising or whatever they might do to try and increase their sales. So I wouldn't say that it all flows through to the margins, because it doesn't.
Right, that's an interesting part here. We have two themes more to talk about. IT again, and we'll talk about in the end. But before that, chemicals again, not as large again as I would be actually happy to talk about again the Marutis and the TCS and Reliance of the world. But still again, if you have the view there on the chemicals, soda ash prices going up, still again the strength is there in a lot of industrial chemical prices. The chemical as a pack, how much stability or a valuation perspective you still again find the sector as attractive as it was since last 2-3 quarters?
Yeah, no, it's not a. To be honest, it's not a sector, because as you said, some of the companies are still, not on our radar really in terms of size. So it's not a sector that I've had to really focus too much on. I think the one theme, if there is a theme that I'm thinking about more and more, is the banking sector. And we have some interesting developments, right, in terms of the private banks, in terms of change of management and so forth. So I'm just wondering how that pecking order of what we think of the stocks today might change in 1 to 2 years' time, with new management at the helm at most of them actually. So that's going to, I think, be a more interesting theme to think about over the next 6 months, and how the new management are taking over, who they are first of all for some of them, and what they can deliver going forward. So it's going to be an interesting time in the private banking sector, and I think that's where the theme and some good money can be made going forward.
Well, Andrew, so are you telling me that it's a good time to actually bet on the banks which were trading at low valuation multiples? Yes, some of that multiples have improved, but still from there compared to the other banks, could be a sort of much higher alpha which could be made. And when I'm saying that, I want to attach a second question here. Are you expecting a better credit growth in the next 12 to 18 months from what actually we have seen in the last 12 months?
So I think what the market's not pricing in, let me put it a different way to you, is that we obviously seeing success in the bankruptcy code and companies being sold, and I think that whilst I'm not saying we're at the end of the overall non-performing loan problem, because there are certain sectors out there which are still vulnerable, we're kind of there or thereabouts. So, I think the banking sector as a whole, and I even include PSU banks in this, could be the surprise of 2019 as hopefully the economy continues to grow at 7.5%, and the recovery process continues, and the good headways that the bankruptcy code have given banks, to get their money back, will be reversed in terms of their write-off. So that's the kind of thing which I'll be thinking about as well in 2019. But I think that could be, so that kind of takes the whole sector to a different way of thinking. But as I said, within the private banks, you do have quite a number of management changes, and it's whether the pecking order of who we like first might change over time with new and different management coming in.
So, are the stocks like Axis Bank or ICICI Bank now replacing HDFC Bank in the pecking order, not in terms of result performance or quality or the track record, but in terms of preference for alpha, preference for valuation catch-up, and also preference again in terms of investment priorities? Is that something which you are spotting is happening at present?
I think in terms of the valuation gap, yes. But the point I was trying to make, and I'll go back to your favourite sector, the IT sector. If you look going many years back, I think the pecking order was, if I remember, Infosys, TCS, Wipro, and then over the years you've had, HCL Tech come in there. And I think the pecking order now would be probably TCS, Infosys, etc. So pecking orders do change because of management, what they deliver and what. So whilst all of these banks will do well because the big institutions with processes, it just makes it more interesting to think, which one of these banks will be at the top of your pecking order in 2 years' time. Once the new management have bedded in some of these and what they will do.
Right, and that's an interesting point for our viewers again. So it's again something which is interesting and worthwhile again to watch out for. But just one word, Andrew, around the PSU banks, since you highlighted that, and that actually I want to ask you is, the top tier PSU banks could be SBI, could be Bank of Baroda, again could be again the Bank of India. But about these PSU banks, do you expect them again to register a sort of disproportionate credit growth because of low base effect, or the way again valuation multiples have been compressed for them? What do you think turning around, changing for them? You highlighted again basically in terms of IBC recoveries, but I'm trying to actually ascertain in terms of valuation multiples where they are right now and how suitable they are again for the investors.
Yeah, again, what I would highlight here is, I'm saying that the whole banking sector, could improve in 2019, and therefore, everything will get pushed up, and valuations obviously are reasonably compelling, or more compelling than they have been for PSU banks. But the problem with PSU banks is that, again, because of management, they're not really be able to kind of build the businesses because of their balance sheet constraints or non-performing loans which they'll still be saddled with. Therefore, whilst the sector will go up and most of them will go up as well, so it's really a sector that you kind of rent in the shorter term for that kind of rise, but you don't really want to kind of own them unless the management changes, there's something more dynamic about what they're going to be doing going forward. Like you've seen, say, in a Bank of Baroda, where the new management's come in, he's tried to do something, it seems to be working, that type of thing. So you need to have that kind of growth path for each of these PSU banks, which is not there for the majority of them.
Right, Andrew, we leave it at, but I think we take as one underlying theme from this show, banking, you have to watch out, private banks, a lot of management changes, again Andrew is highlighting, so again watch out for that, how earnings shapes up, and also PSU banks again, where the management transition is happening. Andrew, thanks a lot for sharing those insights, and with that, it's a wrap on this edition of Market Guru. Thank you so much for watching us.